What's up, everyone? Thank you so much for tuning in. And if you're new, welcome to my channel. My name is Preeti and I am both a real estate and a mortgage broker for close to 20 years. I'm pretty sure by now all of you have heard the Silicon Valley Bank collapse and are probably thinking, shoot, is this going to happen to my bank? Is my money safe? 2 days ago, I read this article that came out of the New York Times that actually broke down as to why SVB collapsed. And today I'm going to break that article down furthermore and bring it to a platform that you and I both understand. But first, you know the drill. Make sure to like, share, subscribe, and tap that bell icon. It gets me motivated to keep you up to date with everything real estate. So first, let me introduce you to Silicon Valley Bank, also known as SVB. It is the 16th largest bank in the US, or shall we say it was. But most importantly, its primary business was with big IT tech startups. 44% of their lending was predominantly within the IT sector itself. That is why ordinary people like you and me did not even know of this bank's existence. Now, in addition to lending in the US, they also have a $400 million book in Canada. They have been operating in Canada since February 2019 as a foreign bank branch, which means they have an external bank license in Canada. Lucky for us, this license limits them. They can't take deposits from Canadian companies, they can only lend to them, which they have been doing quite a lot of. Now, of course, as soon as the news broke, Canada's banking regulators immediately took control of SVB's domestic operations and announced that they plan to wind it down and potentially sell the book of business. So the question lies, how did this happen in the first place? And can this also happen to us in Canada with our Canadian banks? The answer to that is no. Canadian banking system is extremely strong. It may shake, but it may never fall. Now, you know how banks make their money, right? Banks take deposits and pay a very low interest rate to the people who have deposited their money into their institution. Then they turn around and lend that money to borrowers, and the spread between the interest that they are paying to their depositors and the interest that they're receiving from their borrowers represents their revenue. These revenues are further invested in a variety of sectors and portfolios, including the stocks, shares, bonds, etc., basically to help them then generate a profit. But SVB chose to put all their eggs in one basket, the technology sector, Silicon Valley. Now, you may recall in 2020 and 2021, just like the real estate, the tech market was also thriving globally, and the amount of money that these companies were making was significant. Guess where all these deposits were going? A lot of them had bank accounts at SVB, who kept getting a lot of deposits, but they did not have enough clients to lend that money to. And that is why in 2019, they entered the Canadian market and landed up increasing their lending book to tech startups from $200 to $400 million. But that was still not enough. SVB's deposits had touched a $1.89 billion, while their lending only grew up to $66 billion. They still had a significant amount of money in hand, so they decided to invest in different types of bonds. They are the safer investments. All you have to do is wait till it matures. But what they did not anticipate was the drastic rise in interest rates. Now, according to the New York Times, this collapse was an unforced, self-inflicted error when they decided to sell $21 billion worth of bonds for a $1.8 million loss, because many of these bonds they had purchased were yielding an average rate of only 1.79% at a time when interest rates had been risen drastically, and the bank was starting to look like an underperformer in comparison to all their peers. Also, they had this fundraiser that was actually meant to reassure the investors, but unfortunately it had a reverse effect. And it was Peter Thiel, the co-founder of PayPal and one of the most prominent venture capitalists in Silicon Valley, who first sounded the alarm on the failure of SVB's investments. And as he withdrew all his founders' funds capital, he also advised all the companies in his portfolio to do the same. And this is likely what caused one of the biggest runs on an American bank since 2008. Now, there will be detailed postmortem of the bank's failures in the coming weeks and months. For now, it looks like the collapse could actually have been avoided. It happened because management bungled up big time on how it communicated to its customers and the public, and it created a huge vacuum of confidence. Now, does this mean that Canadians who have deposited money in SVB have lost everything? No. Your money is secured up to $100,000. But all this just goes to show that when things get bad, how fragile banks can be. And if people in large numbers start to be concerned with the security of their banks, it could lead to future runs. And if the problem becomes big enough, it could be catastrophic, not only to those banks, but also to the economy in general. So, if you have questions or want clarifications, please do not hesitate to call me. If you still don't know who I am, just go check out my rating on Google and read my client reviews. Till then, take care. And if you found value and liked this video and would like to see more content, click on the boxes on the screen. Once again, my name is Preeti Rao. My contact information is in the description box below. Make sure to hit like, share, subscribe, and that bell icon so you don't miss any future videos. Thank you so much for watching, and don't forget to call me because I hold the key that opens a door to your dream home.